Guys, thank you so much for joining me. My name is Anki Money and this is Anki Money. And so today we'll be looking at what are the main asset classes that you as a first-time investor or someone who's already investing that you need to own a little bit of each one of them for you to say you have a diversified investment portfolio. And before we begin, let's define what is an investment portfolio. Number 2, what is an asset class? Now that today we'll be looking at the asset classes. Number 3, what is diversification, right? So an investment portfolio basically is all your investments put together, or all that you own. Could be you have some shares, or you have invested in some treasury bills or bonds, you own some property, you have some cash in your savings account, some money market funds. All the investments that you own is basically what we are calling your investment portfolio, right? Number 2 is an asset class. An asset class is basically a group of investments that have been grouped together because they have the same characteristics or they behave in the same way. For example, in terms of return or risk, in terms of time. So basically because they behave in the same way, they are grouped together and they are called asset class, right? So the other item is diversification. I know you know about this. Diversification is not putting all your eggs in one basket and basically spreading your risk and being able to know that even if there's a market crash on this type of investment, I am safe in other investments, right? So let's dive into it. What are the 5 main asset classes that you need to invest for you to feel like you're safe and you have spread your risk, right? Number 1 is equity. Other people call it stock, shares, ownership. So it depends. So different investors, different financial advisors call them differently. So equity or shares is basically a way of investing by owning part or piece of a company through buying of shares. And I know I've done so many videos about investing in shares. Please check them out. You can invest by buying shares through NSE. Right now in Kenya we have the Nairobi Securities Exchange, or you can actually invest through something called equity fund, which I talked about. When you have money market funds, equity fund, bond fund, there's a type of fund called equity fund. So people make money through dividends, and I know I did a video on the same dividends, or people make money through share price increase, or both, right? Usually there's no minimum amount of money for you to start investing. However, you need to buy a minimum of 100 shares. So I know people ask this question, so just know that the share price of different companies is different, or different companies have the share prices different. For example, you find in Britain the share price is over 300 shillings per share. Maybe in Safaricom, or for example in Safaricom the share price is below 30 bob currently, right? So you can't say you need 5,000, 10,000, 100,000. No, you need to buy 100 shares from that particular company that you're investing in, right? This type of asset class, you find it's highly risky, and the reason why it's risky is because the market is highly volatile. The share price can change in a span of a day or 2 days. Like you can wake up when the share price is very low, then tomorrow it's very high, or vice versa, right? So it's very risky. However, it has a high return. It's actually higher, if you compare with other types of asset classes, it may end up being the one that gives the highest return in a long-term period of time, right? We go to the second one, which is basically debt. Other people call it equity, other people call it bonds or fixed income. So this is you lending money to the government or to corporates, and the period is between 1 year to 30 years, or the maturity is between 1 to 30 years. So what happens is, if you're lending money to them, you will earn interest income, right? So it's not like the other for stock, where you're able to buy or own part of that company, where they grow, you grow, they go down, you go down. In this one, it's more safe because you're lending money with a certain type of return rate, or with a rate of return that you know that you can even be able to calculate even before you lend the money, right? Because first of all, in Kenya we've not seen the government not being able to pay back the bondholders, but for corporates you need to be very careful. Don't be influenced because you're looking at the big name. You need to look at the credit worthiness of that corporate, because the corporates may borrow money to expand, or for development, for research, for marketing, or maybe they're launching a new product. Then maybe whatever they have borrowed, the reason they have borrowed the money, maybe they don't achieve the objective, so they may not end up being able to pay you the interest amount as promised, or even in our scenario you can lose your principal amount. So be very keen, or be very observant in what type of corporate bond that you're buying or investing in. In Kenya, the minimum amounts that you need for you to invest in corporate bonds and government bonds is 50,000 Kenyan shillings. However, you find the government has different types of bonds. So for example, in infrastructure bond, you need a minimum of 100 Kenyan shillings, right? So bonds are more safe. So you find even though they're not able to pay you back the money and they decide to liquidate some of their assets, you as a bondholder, you are the first priority to be paid back your money compared to the shareholder or the stockholder, someone who has bought shares in that company. So it's more safe. Of course, you cannot compare the return. The long-term return of the stock market is higher compared to the bond. Every single 6 months, you're able to receive your interest income. Then once the maturity comes, you're able to get your principal amount, right? So it's more safe compared to the stock market. However, also the return is also lesser. Also the same way, you can invest directly in corporate bonds or government bonds. You can also invest in bond funds, right? You can go to any unit trust or any mutual funds and be able to invest in a bond fund. So the third item is cash and cash equivalents, right? So basically this is cash from your pocket, from your purse, from your savings account, current account, from your fixed deposit. Basically also these include maybe securities or debts that will mature within a period of 1 year. These include things like treasury bills. Treasury bills is lending to the government but with a maturity of either 3 months, 6 months, 9 months or 12 months. Commercial papers lending to corporates but with a shorter maturity period compared to the bond, right? So anything that you invest or you put or you lend money that you know will mature within 1 year, that falls under the cash equivalents. Also money market funds fall in this category, things like certificate of deposits, promissory notes and stuff like that. However, this type of asset class, I would advise don't tie so much money or so much of your money in here because of inflation. You can't compare maybe there's a person who saved 10,000 Kenyan shillings 5 years ago and now you compare 10,000 Kenyan shillings, the same amount or the same amount in the account. The value of the money has decreased. So don't tie so much money in this type of asset class because of inflation. And also look at it more of a savings option and not an investment option. Don't look at it like you're going to invest and get so much return. The return is very, very low because even banks or even those funds can't promise you so much money because anytime you can need to access your money and they have no right to tell you not to access your money. So they can't even tie your money in investments because they know that you may need to liquidate or to have your money back. So this type of asset has no higher return. Look at it as more of a short-term investment or to achieve short-term goals, right? The fourth item is real estate or property. So real estate or property is of course investing in things like commercial, residential, office, it could be industrial, depending, right? And you can earn money in different ways, and 3 major ways you can earn money is basically you buy a property, then you sell once the value has gone high, right? Then you realize some profits. The other thing is you buy the property, you rent it out, and every single time you'll be receiving rental income, or you lease it out, you buy, you tie it for future frequent incomes, right? The third item is where you invest in shares or you invest in REITs, real estate investment trust, right? Or unit trust. And what this means is you're not personally or physically going to buy a property as you. You're going to invest or to buy shares from companies whose portfolio is mainly the properties, right? Basically, you're able to invest indirectly. So you find this type of asset class requires a huge amount of capital investment, right? Like you need, of course, over 1 million, 2 million Kenyan shillings. However, it's one of the asset class that maybe the financial institutions can be able to lend you money because in itself it's a security. Like you buy property, the house is a security, the land is a security, the building is a security. So you can be able to be financed by the financial institutions. And what normally people do is they do something called leverage, right? So you borrow money, for example, through mortgage, right? So you borrow money as mortgage, then you have a tenant, then the money that the tenant will be paying you, you'll use that money to pay off the loan, right? So the last but not least, it's called alternative assets. So this type of assets, I would say, it's once you've invested in for the first 4, then you can come to this type of asset. And I normally say it's basically for investors who have really a lot of money, sophisticated investors, like people who would invest in things like gold, silver, platinums, you know, and even things like arts or fine wine. art, you know, and things like hedge funds, derivatives, cryptocurrencies. So I don't know, this type of asset is basically for people who've already invested in others, so you feel like you're a billionaire and you have some good money you can buy or invest in it. So I would say for first-time investors or people who are already trying to build their portfolio, go for equity known as stock, shares, go for debt, which is also known as the bonds and fixed income, go for cash and cash equivalents, go for real estate, right? So please check your portfolio and see, can you be able to own a little bit of each for you to be able to spread your risk, that in case there's a market crash, you are safe, right? Bye guys, see you in the next video. Bye.